Hello, this is our second vlog presentation on the subject of sustainability reporting. In this vlog presentation, we would cover four conceptual foundation introduced by IFRS S1. What are these four conceptual foundation? Number one is fair presentation, second reporting entity, third one materiality, and fourth one connected information. Let's begin our presentation. What do you mean by fair presentation under IFRS S1? A fair presentation means that a complete set of sustainability related financial disclosure shall present fairly all sustainability related risks and opportunities that could reasonably expected to affect entities' prospects. In simple words, that sustainability related disclosures shall include all the sustainability related risks and opportunities. In order to have information to be fairly presented, there are some elements to it. If those elements are there, we can say that information is fairly presented. What are those elements? Let's discuss. The first, there are basically two main elements. And then there are subcategories to it. Subsection we can say. Sub elements. Number one is fundamental qualitative characteristics. In that, information must be relevant. Information must be faithful, representative. It must be complete. It must be unbiased, neutral, and accurate. The second major element is, or we can say the second category is, the enhanced qualitative characteristics. What are those? Information must be comparable, information must be verifiable, information must be timely, as well as information must be understandable. So, if all these elements, which are included in fundamental qualitative characteristics as well as in enhanced qualitative characteristics, relevant, faithful representation, comparable, verifiable, timely, and understandable, which are part of the enhanced qualitative characteristics, if these are there, we can say that information is fairly presented. Reporting entity. Reporting entity is an important concept, which means that an entity sustainability related financial disclosure shall be for the same reporting entity of which financial statements are presented. It sounds simple as well as a bit confusing if we read it in the first site. Let's discuss this with an example. For example, there is an organization which has two subsidiaries, and it is working in bicycle manufacturing industry. It has one subsidiary which manufactures the seats of the bicycles, and the second one produces the metal and the other elements of the bicycle. At the year end, holding company consolidated the financial statements of both the subsidiaries. Along with these financial statements, the holding company also consolidates the sustainability related information as provided by the relevant standard related to sustainability, that what metrics and parameters are used for the disclosure. For example, in this industry, in case of uh, sheet manufacturing, probably there would be an element of wastage of water waste. And in case of metal manufacturing, that how they have used the recycled material. So this information is also gets consolidated in the holding company financials. So, in case we take in same, let's say, take this example to the next level, where information is not fairly presented or not completely presented. One subsidiary, sheet manufacturing information related to sustainability doesn't get recorded or doesn't get disclosed, whereas information related to the metal manufacturing is included. So what is happening here that information related to the wastewater probably has not been disclosed, and it could be a crucial information for the investor that how the organization overall is impacting the environment and society it is operating in. It could have other implications. It could create, due to this action or this reason, ill-informed decision by the investor because information is not complete, it doesn't have the holistic information. Second, the investor can lose the confidence and trust. Third, it could also imply that the organization is not committed toward its sustainability related responsibilities. It can have various dimensions. So, in simple word, we can say that it's this definition or this concept sets the boundaries that what should be included as part of the reporting entity, what should be disclosed, what entities uh, financial and sustainability information needs to be disclosed. What does it achieve? It basically it helps in achieving the consistency that how the financial information is presented. Likewise, the sustainability information is presented. So information is relevant, reliable, and comparable. Next important concept is materiality. Materiality as a definition, as a concept, has been used in various professions in a different way according to their own context. For example, in case of accounting and reporting, it has a different definition, whereas in case of auditing, a different definition is used. Likewise, in other cases, for example, in case of risk management profession, it can have a different meaning. Here, in case of reporting, in case of sustainability reporting, as we had discussed previously, that there are various standards and frameworks have been introduced. So different definitions came in. First, we will address the definition used by GRI, Global Reporting Initiative. They have used a definition of sustainability with reference to impact assessment, impact measurement, and inclusiveness of stakeholders. So, by definition, what does it mean? That due to organizational activities, whether direct or indirect, the stakeholders get materially affected. The stakeholders could include government, creditors, lenders, consumers, etc. etc. Then we have the element of financial materiality, which is the subset of stakeholder materiality. The important thing here is to note in case of GRI definition that it does not prioritize how the user of the financial would make decision based on the disclosures. Rather, it focuses on the impact assessment or impact our organization is making due to the environment, on various sustainability related goals. Now, our next point is how European Union is addressing this concept. European Union is using the concept of double materiality. What does it mean? That they are using the stakeholder materiality concept as well as the financial materiality concept. Financial materiality concept is, or we can say the investor materiality concept is similar to the IFRS concept, whereby that information, if omitted, if misstated or obscured, impacts the decision making of the user of the financial statements or user of the financial information. If that's get impacted, the information is material. Let's discuss little further the concept of double materiality. Double materiality basically is outside in and inside out approach. How it is outside in, that how sustainability related issues affects the performance, market position, and future of the organization. Whereas in case of inside out, it means that how organizational activities are impacting the environment and people. Now let's discuss the concept of financial materiality and stakeholder materiality with the help of an example. Let's say we take up the example of Unilever, which is a multinational organization, and as part of its FDG agenda, it selected goal number three out of the 17 goals, which could impact the organization activities financially. As part of its agenda and its objective, Unilever made commitment for the healthy lifestyle or improvement in the lives of the people through these activities, and embedded this in its strategy. And through its operational effectiveness, successful marketing strategy, organization was able to generate huge profit, increase sales. So this becomes financially material. So this information is disclosed as part of the disclosures under sustainability. Now let's have a look at another dimension, which is stakeholder materiality. Unilever also adopted another goal, which is clean water and sanitation, as part of its FDG drive. In this, what happens is that Unilever, we know it's a multinational organization and it supports various uh, communities in underserved areas. For example, in our example, they try to facilitate the local community with the help of local governments easy access to the water and sanitation services. What happens is that it can increase the loyalty, it can increase the uh, long term viability as bringing the success in the business, as well as from disclosure point of view, maybe the amount spent on this is not material. While considering the financial materiality, it may not be required any disclosure. But as part of the impact, it is affecting the life of the people. It has a social implication. So disclosure would be made. So this is how we can see that what information is disclosed as part of the various disclosure requirements under GRI, under double materiality, and then we will have a specific look. Specifically, we will look at the financial reporting related disclosure and definition. Now let's discuss what IFRS says. We have seen European Union definition, we have seen uh, GRI definition. Important thing is that IFRS S1 has used the same definition which has been used in the accounting standard, which is defined in IAS 1. What does it mean? What is there? And what is the reason for that? The reason is that when you look at the development of this standard, they try to kept that users of the financials and preparer of the financials shouldn't get overwhelmed with the various jargons and new concepts. So it becomes complicated, or they may get confused what definition to use while preparing the disclosures. So they kept things similar or same. Let's have a look at the definition. An entity shall disclose material information about the sustainability related risks and opportunities that could reasonably be expected to affect entities' prospects. In the context of sustainable related financial disclosure, information is material if omitting, misstating, or obscuring that information could reasonably be expected to influence decisions that primary users of general purpose financial reports. Exactly same. And I think it doesn't require much elaboration. We understand what does it mean. Our next point is connected information. Again, this is a very important concept because it elaborates that any information which is disclosed, it must provide context. So it enhances the quality of the information. It should connect with the financial sustainability information. Should connect with the financial information, and information which is presented uh, to provide the context. It could be the narrative form, qualitative, or quantitative form. It could be. Let's take an example. For example, there is a transportation company which has got a huge fleet of truck and buses, and it is operating in an environment, geographical region where stringent regulations related to air pollution and air quality controls are being introduced. What could happen in the long run that if organization doesn't take corrective measures, its cost of operations can go high, and it can have a difficulty in operations. If information related to for the investors, it is important that information is disclosed in such a way that they understand that what how organization is managing that risk or create or using that risk as an opportunity. Either or that information would include as part of that disclosure that relevant standard is used for disclosing the information. There are basically under IFRS S2, there are 11 sectors and it is distributed among 77 industries. It's a big number. And different metrics been given. So we have to see that which sector, which industry, and which relevant metrics would be used to disclose that information. Let's come back to our example. That investor would look at that. Okay, for example, how much that GHG gas emission is there, how much air pollution that company is providing metric ton or whatever the unit of measures are. and how the company is managing it against the industry standard. Okay, that's number one. Number two is it is also important to know for the investors that how company is investing in the capex, capital expenditure, how company is utilizing or using it. Are they buying electric vehicles? Are they going for green energy? So what could happen that there could be initial high costs, but in the long run, there would be efficiencies in terms of operational effectiveness as well as reduce cost due to the alternate source of energy. So this sort of information, if it is provided, we can call it that it is connected information giving context. So the user of the financial information or investor can make better decisions based on that. So these are the four concepts, conceptual foundation being introduced in IFRS S1 that we have covered here. And if there are any questions, please feel free to contact me. My email address is being given here.